Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 9, which is for current liabilities and long-term debt. We left off, come on, let me get down to that slide. We left off in our last video talking about bonds. We had discussed bonds when they were at a discount. Okay. Before I move on to the premium, and just as a word of advice, go back and rewatch the videos on bonds, the theory videos, because again, I'm not going to be going over the same concepts again and again and again that you should already know. I'm not going over a beginning theory. I'm only going to pick up where things left off. That's the way accounting works. So if you don't know the underlying concepts, got to go back and pick those up by watching the theory videos and doing the assigned homework problems. Okay, so here for this particular, let me just go down one real quick. All right, yeah. In the last video, we talked about issuing bond payable at a discount. Now, really, premium is nothing more than just the opposite of what we did in the last video. So let me go on a blank slide here. So as you'll recall, and again, I'm going to use the example, that's in the book. I'm not going to be making up different numbers. So if you follow along with, excuse me, if you follow along with what's in the book, I'm going to explain where the numbers come from because I don't think they give a good enough explanation of where the numbers come from in the book. So we know that bonds have a face value of 1,000, okay, and that's par. As far as a market value, when you have par, okay, as far as a market value is concerned, it's given the price of 100, right? Basically what is happening is we're just lopping off the last digit there in order to get the price. We had talked about bond selling at a discount. So if the price went down to 98, that's at a discount, right? And there's a $2 loss there. Well, if the price of the bond goes down to 98, that's $980, which is a $20 difference. Notice that that is a $2 difference, but then again, you're just lopping off the last zero, okay? And it's the same thing with working with a premium, okay? If bonds go up to 101, that means the bond is actually selling at $1,010 because there's a $1 difference there, and that's at a premium. And that's what this video is going to cover, is how to make the journal entries for the premium. The thought process, like I said, is just the opposite of watching the discount videos, so I'm not going to get into a lot of detail as far as the math here or whatever. Let me think about this just for a quick second. If I'm missing anything important that I need. Yeah, I'm not. All right, so from the example that we had previously, let me look it up here. Sorry about that. They were talking about having $500,000 in bonds, okay, and they were at 8%. And let's see here. The maturity value was 10 years. Okay. So knowing that it's 500,000, and since par value is 1,000, that means 500 bonds at 1,000 each. Okay. 8% of the 500,000, so 500,000 times 8% means Annually, $40,000 is going to be an interest, okay? But it's being paid semi-annually, so we divide that by 2. So that means each semi-annual period, $20,000 is going to be our um, interest expense, and that's going to occur over the course of 20 years. Right? So when we issue the bond, in this case here, they're saying that for a bond premium, bond selling at a premium, they were selling that the bond is selling at 515,000, right? So that's $15,000 more, and that's the premium. So let's see here. To make the initial journal entry, right, and they're dating this April 1st. Let me write this down here, and then I'm going to work backwards. In other words, I'm going to write the first entry here and move up the screen as I erase stuff in order to be able to show the entries as I occur. I'm not going to start at the top and then work down because I've written all of this stuff here. So I'm going to start down here at the bottom. All right. So on April 1st, when we sell the bond, remember that selling these bonds, we're selling it on the secondary market, and that's why we're getting 515,000. When the bond was initially sold, it was sold at 500,000 to somebody. That somebody puts it on the market, on the secondary market, which allows the price to be able to go up or down as far as a premium or a discount is concerned. And that's how you get a difference in the price on the bond there. And so the person selling it on the secondary market, they're going to receive cash. So we're debiting cash for 515,000. Okay. We know that the bond, that's a debit. We know that the bond is for 500,000, all right? So we have to credit bond payable for the 500,000, and the difference between the two, you know, simply put, is if you look at your debits, debits must equal credits in a journal entry. So I take my debits less my credits, and in that case it's 15,000, and I have to credit my premium on the bond payable for the 15,000, so that my journal entry works out. And that's all there basically is to it. You did the same thing for recording that uh, entry for the discount. All right, you book your cash, you book your bond payable, and then you back into either the discount or the premium. Right, it's just that simple. Like a three-step process. 1, book the cash. 2, book the bond payable, and then 3, the difference is your premium or your discount. All right, and you're backing into that portion of the journal entry. All right. So you've booked the actual bond itself. Now you have to go, and we're going to be dealing with the. Let me do it in blue. We are going to 6 months later, because every 6 months this is semi-annual, right? Which is the most common way payment of interest on a bond using the coupons. Okay, so 6 months later it's 9/30, and an interest payment has to be made. And like we just calculated, $20,000 is the interest payment. So that's going to be cash going out. So we're going to credit our cash for the 20,000. Okay. Now, we have um, we have to consider, all right, that we have this here 15,000, all right, as the premium on the bond payable. Just like in the discount, all right, we're amortizing that, we amortize the discount when we're amortizing the premium also. Okay, remember, this is just the flip side of the coin. It's like accounts receivable and accounts payable. It's two sides of the same coin. We're doing the exact same thing as we did with the discount, uh, but we're just doing it in the opposite fashion. All right, so let me get rid of this here. So if I have this premium for 15,000, okay, and remember, I'm amortizing this interest. So over the course of 10 years, if there's two payments a year, right, that means I'm going to have 20 payments. So I divide the 15,000 by 20, and I end up with $750 am of amortization against that 15,000, right? So that ends up being a debit against the premium on the bond payable. And that's $15,000 as a debit. All right, let me erase this here to make it a little easier to see. So that's 15,000, I'm sorry, not 15,000, 750. That's 750 here and 20,000 here. Okay, so now, we can go and say, okay, we could take our 20,000 and subtract 750 and get 19,250, which would be our debit for our interest expense, okay, which would be 19,250. Okay, that's how much is going to end up. That's how much is going to end up on the income statement. Okay, and again, to uh, further solidify this as part of your thinking, remember, this here is we have a debitor bond payable. That's a payable. That's a liability account for 500,000. When this bond gets completely used, our bond payable needs to be zero. And we have a premium on a bond payable for 15. Okay, that $15,000 also ends up being zero over the course, once the bond matures. So this here 750, notice that this here is a credit and we're debiting, the premium on bond payable. So every 6 months, we're going to be reducing the 15,000 for the premium on the bond payable by $750. It's very, same concept as depreciation. Just, you're lowering that, your accumulated depreciation lowers the book value of the asset itself. Well, we have this bond payable, and we're reducing that bond payable either by the premium in this case or by the discount. And whether it's a premium or discount determines whether these are debits or credits. All right, but you don't have to memorize it. Okay, as long as you think through, this initial journal entry, then you can uh, work through the adjusting entry to it. Okay, every 6 months when you make that interest payment. So that's how you book your interest payments, uh, every 6 months or whenever the interest payments become due. Okay. Now, and of course, now when 10 years down the road, um, you're going to have, let's see, what would be that date? That date would be March 31st, uh, 2024. Okay, that's 10 years down the road. Okay, so you're going to have to pay out the cash, for the bond payable because the person is going to come in and want the cash for it. So I'm going to credit my cash for the 500,000. Okay, and of course, when we pay that out, we have to debit our bond payable for the 500,000 because they cashed in that particular bond. So that same entry is the same exact entry that you're going to make as if you were doing the discount. When the bond matures, you have a face value of $500,000 on those bonds. The person comes in, they say, "Here's my bond, give me my cash for 500,000." And so now this debit for the 500,000 offsets the credit for this 500,000. Okay, and that bond payable account ends up being zero. And remember, this premium on bond payable of 15,000, every accounting period, right? This is a credit and this is a debit. Every accounting period, not every accounting period, every 6 months, we're going to offset that 15,000 by the 750. So over the course of 20 periods, or 10 years, the balance in that premium on bond payable account will be zero. And what are we left with? We're left with, um, you know, the cash off, here the cash offsets the cash, okay? And we have the $15,000 in cash that's sitting in our account that we received as a premium, okay? Everything offsets itself, right? So premium, if you understood discounts, go back and watch the discount video, all right, which is bond.4, all right. This here is going to be bond.5 when I put it up. Um, but go back and watch that theory video. If you understand the discount, then you understand the premium. It's just the flip side to the coin. So watch that first and watch this one again if you're not getting this, okay? And if you still don't understand something, feel free to telephone and speak with an instructor. Okay, um, so that's kind of it as far as the discounts and the uh, the premium. So the only thing that we have to talk about for bond payable is making adjusting entries, and we will do that in the next video.